Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, small cap and mid cap stocks have been, they've been on a high and they've been the stars of the market lately, outpacing even the large caps. So, what is it that's driving this rally? What are the risks associated with investing in small caps and mid cap stocks? We'll discuss all of that and more with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, to begin with, small cap and mid cap stocks, they have delivered exceptional returns of late, even outpacing large caps at times. So, what is it that's driving this rally, and is this rally really sustainable?
Broadly, two reasons why small caps are able to hold the ground. They have done well and they have been able to sustain it. Primary reason is that this time for 4, 5 years, 6 years, domestic market is driven by individual investors, their SIP book, the news that you come across, 20,000, 21,000 every month. And good part of it is coming into small cap. So if money is flowing into small cap fund, it has to necessarily get invested there. That apart, many small cap companies have been able to improve their performance. They have done better. They are able to scale up. They are able to grow. So both reasons, rising, growing earnings of small companies and investors fancy for that, largely led by domestic investors. And when foreign investors, even they have pulled out, they dominate the large cap category or the larger mid caps. That does not hurt the small cap as much. So, the kind of resilience these small cap funds have been able to derive because of investors' participation is very significant. So both reasons, small caps doing well and small, investors believing in them.
All right. Is this rally sustainable?
It may not be sustainable for a while. This market will always be like this. You will have this intermittent, phase when markets will collapse, when markets, it will look like we haven't seen a collapse of any meaningful kind so far. But in last 4 or 5 years, we have seen those intermittent corrections. And if these small companies, they keep getting money the way they are, and which will keep getting invested in the small cap stocks, there is a possibility that some of these companies, the valuation may cross well beyond its justified limit, and the framework may go out of whack, and that is when one should worry about. But I don't think, here's a very large universe. There are a large number of companies listed in India. The kind of optimism that drives them, the kind of performance that is driving them, and in between the small cap universe, the good thing is that the universe is so large that if 100 companies falter, all the portfolios will not go haywire. When it comes to large cap, if 5 companies falter, all the stock market crumbles. So I'm hopeful that it may turn out to be not as bad as people are expecting. And if and the kind of investors pouring money, the individual investors coming with their SIP, that I think is very comforting.
All right. Now, small and mid cap companies, they are known for their high growth potential, but they're equally risky because some of them just vanish, off the radar. So, what are the biggest risks that investors should be mindful of, or is there a way to mitigate those risks?
Small cap companies are risky for the same reason that you're saying, that some of these companies, they're small and they will not be able to withstand the cyclicality of the market. If there is one company is faced with a very high interest rate or some change in the regulations or some change in the market dynamics, if there's export unit or something like that, small companies are more vulnerable, they can die. That is one part. The second part is that many of these small companies, they could be too richly valued today. And because they have grown faster, 100 crore revenue can grow to 200 crore, can grow to 400 crore, can grow to 800 crore. And after that, will it grow to 1600 crore? When this 800 to 1600 crore leap will not happen, that is when the valuation will be extremely high. People will be disappointed and it will stop growing. Assuming that a company is able to grow its earnings or revenue in 5 years' time, double its revenue in 5 years' time. And in the next 5 years, when it has scaled up, maybe the business itself is not scalable. Maybe they are unable to bring all those variables which will lead to larger scalability of a sustainable kind. So those are very natural risks. Those are very inherent standard risk of a small cap, small business turning big. In fact, the small cap fund is designed, and now the regulations also permit them, that a small cap fund could be 40% non-small cap stocks.
Okay.
So in that sense, the risk framework for small cap funds is very attractive. That makes it worthwhile, and you are able to derive a substantial benefit of that. Not only that, I think small cap funds hold a greater promise than a large cap fund or a larger mid cap fund, simply because the universe of investment for the small cap is very large.
Right.
When you give your money to a large cap fund, he has to invest in top 100 companies. You choose, your universe is very small. Next 200 is mid cap, and subsequent universe is small cap. Now, in this subsequent thing, I don't come across, if you look at the large cap portfolio of any large cap fund, there could be 80% commonality. The portfolio will be similar. Likewise for mid cap, I don't come across too many unique names in mid cap portfolio. But when it comes to small caps, all small cap funds are different. Every fund manager is able to apply his mind, apply his thinking, apply his judgment, and apply his rigor. And so also I find that small caps, as they are getting bigger, they are far more diverse. Some of the very successful small cap funds are over 200 stocks, which would have been impossible in the past, but they have turned big. And so I think the small cap fund case is very strong. But have your expectations, moderate your expectations, because this will not last forever. It will have all the intermittent steep corrections. Be ready for it.
All right. You said the case for small cap funds is very strong, but there are over 25 small cap funds. There are around 30 mid cap funds. So how does one, go about choosing the one best suited to one's needs?
Very difficult. I would say that if you have to simplify your framework in terms of how do you go about quickly choosing one, choose a fund which has been able to beat the benchmark on a 3-year and 5-year basis. Narrow your universe. And I think our 5-star, 4-star universe will be somewhat like that. And within that, choose 2 mid cap, 2 small cap, and make sure that all these 4 are from different fund companies. So you will have diversification, and you will not have complementary portfolio.
All right. So how much of an investor's portfolio should ideally be allocated to small and mid cap funds?
There is no such rule, and but I'll make one. Make one from the point of view of the very practical things which one should keep in mind, that the money that should not be in equity should not be in small cap. So the money which you need in 2 years time, 3 years time, 4 years time should not be in equity, or should be put very conservatively. The money which can be put in equity is the money which you are unlikely to need in the foreseeable future. It is going to support your income, or you could be a retired person, but you will get your pension from your employer and you don't need to consume it, so that money can also be in equity. Now, how much of it can be in small cap and mid cap is a matter of your experience. It's a matter of your experience. So one is to decide how much of your money can be in equity. If you are used to it, if you have been investing for 5-10 years, if you know that okay, this market madness will remain, and you have got very used to it, you don't mind stocks, your portfolio going down by 20-30%. In fact, you feel happy sometimes, that, or you are just not unnerved by that. You can well have 70-80%. If you are carrying a small cap portfolio, I know many investors who know their companies very well. They understand where they have invested. They are not, because when you don't, the biggest risk comes from not knowing what you are doing. When you have invested in a company, or when you have, and in case of mutual fund, you don't know where you have invested. But the diversification is able to moderate your decline much better.
Right.
It is able to provide you a much better, superior, a shock absorber, so to say. That you can have many companies which go down in value by 70-80%. You don't come across a mutual fund, a small cap fund. Of course, the small cap funds have also gone down by that to that level once in a while, but they can go down, but not extremely. If you are comfortable, if you are used to, if you are acclimatized investing for 10 years, you can well be 60-70% into small cap. I would rather ask this question, that who should not invest? An investor who is investing for the first time. If you have started investing in the last 2-3 years, if you have not seen a big decline, you should not consider a small cap, simply because the returns are good. They will actually tot up, they will in the list. When you look at value research online, you go to the category watch and look at small caps will always be at the top, and that will tempt you. But avoid it, simply because you are just looking one side of the story. The return and the risk is not visible here. So first 5 years of your journey, don't invest in small cap. Once you have seen a big decline, then you are ready for it. If you have a kind of money, a money which goes down, and there are different people with different temperament. There are retirees, there are people in their retirement, old people who are very aggressive because of their context, because of their situation, that they don't need to, take the capital from their investment. There are young people who have immediate need. They have some serious goals, important goals in 2-3 years from now, and they could be conservative. So you can't really have
you can't
a
bunch
rule.
them into.
You can't bunch them. That old people do this, young people do this. No, it's entirely it should be guided by your goal and your own experience. Have small cap in limited quantity, if at all. And you can do without having them, because if the moment you invest in a multi-cap fund, a flexi-cap fund, you are getting a small cap exposure, and you are getting in a nice package which will not unnerve you that often.
All right. Now, somewhat related to this is today's viewer's question. Now, Satish Bansal says, I've been investing in mutual funds for a long time. My style is aggressive, and I don't panic during a market fall. So I didn't withdraw during the COVID-19 drop. Now he goes on to ask, with a 20-year investment horizon, what will be the pitfalls if I invest only in mid and small caps?
If he is investing regularly, and if he is investing with this time frame in mind, 10 years and more, I don't think there is a pitfall. COVID was a very brief period. That was a steep decline, but it was not a decline which many investors were unable to. If you have to really look at the decline, you should look at 2008 decline. From January 2008 to October 2008, many small caps, mid caps went down by over 60%. And the COVID reversal was very sharp. 2008 reversal, it took longer, 2-3 years time, or 18 months time. So you have to see that it could be a test of patience. It could be very unnerving. You have seen, and more so once you have seen with great anxiety and great happiness, the peak level just before the big decline. Before you certify yourself, think of what could be, because look at your real situation. When will you retire? When your child will get into college? When do you need the big things? And if you have provided for, if you have sufficient margin of safety, then you can well take the risk, because our risk-taking capacity goes down dramatically based on our situation. You could be risk-assuming person, but if you need the money 3 weeks from now, that is not the money you want to take risk with.
All right, with that, it's a wrap on today's episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.